we're going to cover some of the common mistakes first. The first mistake that many business buyers make is confusing revenue with profit. Well, this business does $10 million a year in sales. And the mistake is thinking a business with high revenue must be valuable. Well, I can show you businesses that do 10, 20, 50, $100 million a year in revenue that I wouldn't want to own, because there's a reality. And the reality is that revenue means nothing if the profit margins are weak. A 10 million revenue business with a razor thin margin may be less valuable than a $1 million business with 40% profit margins. Which one would you rather own? I'd rather own the 40% profit margin and make them have a profit of 400,000 than to have a $10 million business that's maybe making 100,000 a year in profit. I've seen them, and maybe you've seen those businesses as well. Now, the solution is to focus on profitability. That's EBITDA, earnings before interest, taxes, depreciation, and amortization, or something else called seller's discretionary earnings. You may have seen it when you talk to business brokers as SDE. But it's not just the top line revenue that matters, okay? It's not just the EBITDA. It's not just the seller's discretionary earnings, because there's more to it than that. And we're going to try and identify and isolate those for you as well today. And when you get those wonderful terms from the broker or the investment banker, whatever size business you're buying, and they're looking at this great EBITDA or this great SDE, don't forget to subtract a market rate salary for the owner. And an example would be a $10 million company making $1 million a year in EBITDA. But the seller is only showing that he makes $50,000 a year. And to replace the seller with somebody of that capability might require $500,000 a year in today's market. So the business isn't making $1 million. It's really only making $500,000 after you pay the people that work there at their market rate, and that includes the seller. So that's an important concept for you to have a grasp of. But don't confuse revenue with profit. You got to scrape away everything to get down to what is that real profit of the business. That's what you're looking for. Ignoring owner dependency. And the mistake is assuming that the business will run just as well after the owner leaves. Well, that's not the way it works. That business is what it is today because that owner gave it his blood, sweat, and tears for 10 years, 20 years, 30 years, who knows how long. They know the business inside and out better than anybody. And when they leave, all those contacts, all that knowledge leaves with them. All the rapport with the employees leaves with them. Everything that's producing those financial statements leaves with them. And just because you have a lot of confidence in yourself and you're going to step in and fill the owner's shoes, it'll be years before you have what that owner has when he walks out the door. The reality is that the business is too dependent on the seller. Their relationships, their specialized knowledge, the value drops because success may not transfer to the new owner. And the solution, there is one, is to be sure to check if key employees, documented systems, operational processes can sustain the business without the owner. That's the difference between a business that's scaled for growth and a business that's all run out of the seller's head. And depending on the size of the business, I will guarantee that a $5 million a year company is mostly run out of the seller's head. Whereas a $50 million a year business, chances are, if they're growing and profitable, that it has documented systems, operational processes. It's been scaled for growth, and the owner can step out the door. And if there's key management in place, it will continue on. And you've got to be astute enough to look into that business and see what that difference is and whether or not that scalability is there. Overestimating growth potential. That's one of the biggest single reasons why entrepreneurs tend to overprice businesses. And the mistake is assuming the business will keep growing just because it has in the past. Well, businesses are worth what they're going to do in the future. But nobody has a crystal ball that's going to tell you for sure the growth of that business. And it's easy to be optimistic because a certain economic condition exists today. that can be obsolete tomorrow. Look at how fast the world is changing. Look at how fast just a new technology like artificial intelligence is revolutionizing a whole bunch of businesses and the way that they operate. And they're going to either keep pace or they're going to go out of business. New industries are coming in that are going to obsolete old industries. You don't have that crystal ball. And the reality is past performance does not guarantee future success. Competition, industry trends, or market saturation can impact the growth of that business. And you don't have a crystal ball for all of them. You're going to have insights and intuitions about what the future may be, but you have to limit what you're willing to put on any business today in terms of value because of what you think it's going to do in the future. Businesses becoming obsolete can literally be overnight. It was a sort of a solution, which is to validate the growth assumptions by looking at industry trends, looking at customer demand. Is it increasing? Is that something that's going in the right direction? And the competitive landscape. And we don't have it on there, but also the technological landscape. What's going on in the world of technology that could dramatically increase your business? What's going on globally in terms of different markets? What's going on politically? An example would be in this country, if you're going to go into manufacturing, it's probably a pretty good thing because the administration for the next 4 years is going to be pushing manufacturing growth, bringing industries back on shore that for the last 20 years we've been pushing offshore. So this is a part of that process. And what you should be starting to realize already is valuation is not a science. I've been doing valuations on businesses for damn near 60 years. But I have to tell you, there's no science to it. There's no certainty to it. It's at best a guess. It's at best an estimate. And there are things that affect it, good and bad, and you want to understand those. And when you're all finished with all of that, you're going to be within a range of value, not an absolute value. So there are two things that are going to determine the value of your business. One is getting into that right range, and then your ability to negotiate the deal. Value is in the mind of the beholder. And I will guarantee you that the seller's mind, in the mind of that beholder, the seller, he thinks his child is worth a fortune. And it's going to be up to you to really convince them that it's not. And so we're going to try to give you the tools for doing it here today. That's part of what we're giving you the background for, the argument. Using the wrong valuation method. And the mistake here is applying a generic rule of thumb that's a multiple without considering industry differences. For example, a software as a service company, a manufacturing firm, and a restaurant have very different valuation methods. And using an incorrect multiple can lead to massive miscalculations. That we're going to cover this in a minute. But a software as a service company has a built-in subscription system, dependability of income, and a trend line that's usually going to be dramatic growth into the future. So it has a certain growth structure that might command 8 to 10 times earnings. Whereas a manufacturing company, even though they have customers that reorder and distributors and a good base, you're going to find that company is going to be valued at 3.5 to 4.5 times its EBITDA. And a restaurant, whether it's making money or losing money, it's going to depend on the location. Is it in a growth location? Is it in a deteriorating location? At best, it's going to be valued at 1 to 1.5 times its gross sales. And that'll be true whether it's losing money or not, because the theory is that a good restaurateur will take it over and they're going to do with it what they're going to do with it, but they're hopefully going to be a good chef, know how to market, know how to entice the public in, put a nice new clean face on the restaurant that's attractive, whatever they're going to do. And so restaurants come and go, and they usually sell at 1 to 1.5 times their gross sales. All right. And it doesn't matter whether they got a good kitchen or a bad kitchen. It somehow doesn't get into the equation. It's all about a formula that the industry has come to adopt. But you got to be careful because you've got to decide when you've gone through the standard multiplier that everybody's going to tell you what it's worth, that restaurant is in a good location. It's got decent equipment that you don't have to replace right away. You don't have to redecorate, or if you do, you price that into the acquisition. But there are all kinds of things that are different about different industries, different companies. And the solution here is to be sure you're using, as a part of your evaluation process, industry-specific valuation multiples and apply the right approach. And there are different approaches to valuation. One is called earnings based, based on its earnings. One is asset based. What's it worth? If you were to take all the assets and add up their value, what are they worth? Is it revenue based, like the restaurant, 1 to 1.5 times revenue? Or is it discounted cash flow? And discounted cash flow is another one that I see as ridiculous, because what it does is it says, okay, if you got so much money coming in now in the way of profit, what would you have to have at a certain amount of money value in order for you to earn that much profit over a certain period of years at present value? So you take the first year's income and that's worth X. Then you take the second year's income and that's a discounted value for X, because X won't happen for another year. And then you take what you expect to make the next year and you discount that even more, because that won't happen for 2 or 3 years. And you keep doing that until by the time you get out 5 or 6 or 7 years, the amount of discount is 100%. So you have this discounted cash flows, you add them all up, and that's the value. Well, that's ridiculous. You still don't have a crystal ball of knowing what income's going to come in the future.